Hello and welcome to Trade the Trend. My name is James Boyd. We welcome you on this Thursday as we talk about where are those trends and what trends are we riding. We've got a lot of examples here today of different types of trends, current examples in the paper money account, and also new examples that I want to discuss here. So we welcome all of you. We also have Brent Morris in the chat, so we welcome him as well. And many of you actually said, James, bring back that red shirt. Now, this is what we think of that red shirt. Okay, not going to talk about the red shirt, and we'll talk about maybe if you're a bull, kind of what are some areas that you're looking for, and we'll talk about that. And also, are there some examples of some bearish trades? That's if you wanted to, and that's actually been a theme that we actually brought up on Monday, and I want to follow through on that today in examples. Now, let's go ahead and get started. Now, remember when we talk about examples, we'll talk about stocks and option examples. Remember that options carry a high level of risk and are not suitable for all investors. The information provided here is for general informational purposes only. Understand that there's different types of analysis, like technical analysis, fundamental analysis, macro analysis, probability analysis, intermarket analysis. All of it is good stuff, okay? It's very interesting to kind of see different viewpoints, okay, and learn from those. And also remember when we talk about examples, and we definitely want to bring up what is the risk of that trade. Is it defined or undefined? And also understand that when we talk about investing, we could lose principal. And also when we bring up, let's say, short options, if we do, remember we're talking about American style options. Those can be assigned at any time up to expiration, regardless of the in the money amount. And also when we talk about options, we want to bring up the option Greeks, okay? Know that delta, gamma, vega, theta, they measure a sensitivity, okay, to something, as you see right there. And we'll talk about that, delta, sensitivity and option to changes in the price of the underlying asset, okay? And also remember that gamma is just the change in the delta if the price of the underlying asset moves a dollar and so on. So have an understanding, these are like sensitivity measures, okay, to something, volatility, time, etc. And also remember when we talk about our examples here today, and our agenda will be as follows. I do want to take a quick look at the market. I want to talk about some levels, okay? We talked about some upside levels here yesterday. I want to actually look at some downside levels here for potential higher lows. I want to just quickly look at sectors. I definitely want to actually look at commodities. And with that, I want to bring up interest rates. And then when we talk about interest rates, you know, we've got to maybe just kind of bring up the US dollar and kind of what we're seeing there, because there's some massive trends in that space. Are people buying more dollars, or actually are they getting rid of US dollars? And is that creating a trend? Now, with that, we'll talk about some current examples that we have. I've had some questions, and I'll get to those, and we'll lace that in that discussion. But we'll also put on some new examples, and we'll also include an example for the financial sector. JP Morgan tomorrow, over earnings, bearish example. We'll look at that. So let's go ahead here and just let's start with the good old SPX for just a moment, okay? Now, if we zoom in on this was the chart that we really brought up yesterday. And what I'm going to do is I'm just going to kind of point out the marker that we did yesterday. So yesterday afternoon, on Wednesday afternoon, I teach the fundamental class, and we talked about how really the S&P there, really, when we look at the top there, and I included down to the wick, okay, for some of you that like to look at wicks, we got above the 61.8% level. Now, we know that if we get above that Fibonacci level, we would like the 50% to be the first level of support. I mean, if it went perfect, okay? So far, it hasn't gone perfect. You actually see that what's the secondary line that we like to hold if an investor was bullish? Well, it would be the 38% line. Did it hold that? Intraday, it went down below there, okay? There. So far, we're above it. We need to close above it. But overall, we would say it didn't hold the first level support, number one. It's holding so far the second level. Why is that important? Well, because remember, these big, large candles that look like Eiffel Towers, this is what they call S1. Now, we would say that it went down farther than maybe what some bullish investors wanted, but overall, it's putting up a little fight here. Okay. Now, why are some people selling? Well, sometimes when you get the markets to go back up, some people say, thank heavens, I got to go back up, and now I'm going to maybe sell into the strength, get rid of some of my stocks or what's in my portfolio, and try to raise cash. When might they stop that? Okay. Well, if the market goes up more, they might have second thoughts about selling and might not sell as much. So this is not unusual that you actually kind of see a little hard pop yesterday. Today's some selling down, but we're watching those levels. The level that we're going to watch in the S&P, 51.95. That's a 38% fib. Now, the Dow, by the way, looks very similar to that. When you look at, let's say, the NASDAQ itself, we bring up, let's kind of draw those fibs. Let's kind of get those levels to be watching there. And we go up from where did this top out? Where did it go down to? I'm going to go down to the wicks for some of you like to do that. It looks very similar. NASDAQ closed above the 61. And it is mind-blowing that it was able to go up that much in one day and retrace that much. Same thing here. If it was perfect, okay, which it wasn't, we'd like it to really hold 18,416. Second, we like it to hold the 17,972. Now, today's intraday low was right around the 20 period moving average. Is that abnormal? It's not, okay? You get a diagonal breakout and you get a little check back. Not unusual. So a lot of times people will see, oh, red candle, signs of weakness. Remember, when you make a higher high, HH, or higher high, right? What happens after the higher high? Well, you get the pullback. And now we really find out, are the bulls for real? Second, are the bears going to cave in and tap out of those bearish positions? So when we say tap out of those bearish positions, if investors are short, to get out of those bearish positions, they have to buy back, or that's one way they can do it. If they buy back, you can get two things happening. Short sellers exiting those short positions, and bullish investors maybe buying stock to start a position or add to positions. So now, that's kind of what we see there. The VIX, just real quick, volatility sloshing around. We were down to what, 34 in the VIX? Shot up to about 55. Hey, like we said before, when the VIX is high, this is like where the lake or the ocean has some pretty high waves. We've been in that since last Thursday, okay? Still the same. Again, what you like to see this, if you're talking about bullish, you like to kind of see this fade down. Now remember, for every 16 on the VIX, it's about a 1% expected movement on the S&P 500. So if we had, let's say, an VIX level of 32, they're expecting really a fluctuation of 2%. If we're at a VIX level of, let's say, 48, do the basic math, okay, they're expecting a 3% range on the S&P 500, or the expected movement. That doesn't mean it's going to happen. But so there's still some pretty good volatility here. Some stocks being hit more than others. Now, just real quick, when we talk about, let's say, some other things that do deserve to be kind of at least mentioned. Gold. This is one that's not been shy here. We're going to talk about two positions in this space. Gold up another 90. Now remember, I said before, and I've never said this, okay? Gold has been acting like a sector. Some people like to buy staples. Some people like to buy utilities. Some people like to buy healthcare, real estate, whatever. Gold, precious metals, to some degree, has been acting like a sector. Gold, as there's been uncertainty, recently it pulled back when the market did, but there's been some pretty strong movement here lately in gold. Crude oil, when you take a look at crude oil, 55 yesterday, selling off a little bit here today. How does that relate to the energy stocks? Well, you're going to see as crude has collapsed, so is the energy sector, okay? Now, the one thing that stands out quite a bit is the U.S. dollar here today. Please tell me, okay, that somebody was watching this. Now, this has been a pretty big move. We're talking about 1.7% on a currency, okay? And this is looking at a basket of, it's looking at the U.S. dollar relative to other currencies. What's the biggest currency in the basket? 56, 57% is in euro. So if this is actually going down, the euro, by the way, anyone actually in Europe right now and sitting on euros, the biggest thing is the euro is probably going up quite a bit. Now, the euro was up 2%. It got to 112, okay? The Japanese yen, which we've talked about quite a bit, that's up 2%. The Swiss franc, which is also kind of if people are nervous, okay, or scared, whatever you want to call it, or there's maybe a bearish theme in the market, the Swiss franc up 3%. So investors right here, some of them, fleeing the US dollar and going to other currencies. Now, last thing I want to kind of say on this is when we bring up TNX, CGI, which is the 10-year rate, in the last couple of days, so usually when markets go down, usually rates decline as well as investors are forecasting economic contraction. But when we kind of had this happen in last week, we saw the rates shoot up. So that is abnormal. It kind of leads us to believe that some of those larger investors, which could be also foreign countries as well, selling their treasuries. And if there's not maybe new buyers, the rate typically rises to have other investors in their place, okay, or to have a more active market for those type of products. So we actually saw the opposite. As the stock market fell down, rates rose aggressively. So what's the major takeaway here? Oh, gold is still there, right? Crude has really gotten pushed down. The third thing is here, we see rates going the wrong direction. This is kind of leading us to kind of believe that investors are shifting money out of the U.S. into other countries and or currencies. And as I say currencies, some of the investors are actually liquidating some U.S. dollar positions, or they're thinking we're not going to need as many U.S. dollars based on some of the things we've had happen lately. So these are some of those massive trends that are going on right now. Now, the couple things that I kind of want to point out, healthcare, when you take a look at healthcare, that's had a pretty good bearish engulfing, back down. Now, luckily, we don't have the sector of healthcare. We have UNH. Luckily, that has actually done a little bit better. We'll bring that up. You don't have a lot of positions, or that's the only position. But healthcare getting pushed down a little bit. I already mentioned energy. The technology fading a little bit, but kind of trying to sit on that moving average right there. Keep an eye on that. But not a dark cloud cover candlestick, but kind of fading off pretty good. You look at, let's say, discretionaries there. Dark cloud cover, it's closer. Probably so the worst area is discretionaries compared to technology, okay? Now, what I want to do is I want to kind of pull up an example. And I want to go back to gold for just a moment, okay? Now, has anybody been watching? Has anybody been watching gold stocks at all? Okay. Now, in the portfolio, let's show this, okay? We have a position in AEM. I'll show you that position in just a moment, okay? Let's kind of talk about a new position for just a second, okay? When I go look at the charts, I'm going to type in NEM. Now, for some of you that, let's say, James, could you share with me this chart? Yeah, let me just send this to you. So this is just going to be the chart that we're looking at so we could be on the same page, okay? Now, if I pull this up, what you're now going to notice is I'm going to zoom in on this. Now, I'm going to start with a bullish example. I think most of us are bullish people, okay? We tend to buy, we try to buy things that tend to rise in value. So let's start here with an example, and then we're going to kind of switch the types of trends we're talking about. Well, if what you're now going to notice is this is one of the fewer stocks, you kind of see a little breakout here. Now, I think this would be interesting to watch this. NEM, Newmont Mining, okay? I want to bring up just real quick, if I go to studies, and if I go to, let's say, quick study, and I'm going to go compare with, I want to kind of see, let's relate this to the sector for just a moment, just real quick. IXB, is it related to the sector? And, let me go to this chart. NEM, okay? NEM, let's go back to studies, quick study. Let's go to compare with, custom symbol, and I want to kind of show you something. Now, the one thing is, there you go. If you look at this, the purple line, fuchsia, is the sector. The sector has dropped down. And now, candlestick is NEM, okay? Now, what you're going to notice is base materials under pressure, but then lately what you're seeing is kind of this stock is kind of inverse almost to a degree to what the sector is doing. Now, what I want to do is I want to kind of find out what is this kind of really related to. If I change this and say, is it more related to, let's say, gold price itself? You look at this, and there has been a pretty good correlation. The fuchsia line there, or purple, whatever you want to call it, lilac, whatever, you're going to see that the line and the candlestick are more in line with each other. Okay, now, that's historical. That doesn't mean it's going to be that way in the future. But it's something you would definitely keep your eye on to say, hey, if gold is going up, is there a correlation? Now, if you said this candlestick and line kind of confuses me, well, don't worry, go to style, go to chart type, candle, let's just go to line chart. And so now what you're going to see is you got two line charts. The green and the red, green is when the stock is going up, red is when the stock is going down. But now if those lines are almost overlaying on top of each other, you have that more positive correlation, okay? Now, how do you bring it back? Style, line, candle. Now, what I'm going to do on this is I'm going to go back to the paid money count. Now, how many of you are actually thinking, James, I'm willing to do a trade on this, but I'm nervous that the stock might go down? Any takers on that? Any takers? Well, so this kind of goes back to what we talked about on Monday, okay? Let's say the investor says, I want to be bullish. I want to buy the shares of the stock. That's normally what I do or consider. So step one, I'm going to go to the trade tab. Once I go to the trade tab, I'm going to click on the ask price, okay? I'm going to click right on the ask price right there. Once I do that, it comes up with plus 100. Now, when we click on this, let's say we click on the ask price, the default, you don't have to have it. You don't have to buy 100 shares. It defaults to 100 shares of stock, okay? That can be changed. Step two, what we're going to do is going to go single order. First triggers SEQ. And this just means do it in the sequence that we wanted to. Number one, buy the shares, okay? Number two, what we're going to do is we're going to try to have some upside potential to this. Now, if I did this and said, look, we're willing to sell the shares at 52.5, okay? If we do that, in this case, what I'm going to do is sell the call. Now, if you take a look at this trade, what type of trade is that? What type of trade is that? That's a covered call. Buying the shares of the stock, selling the call. Now, if we kind of brought this up a different route and said, look, could I just right-click on that, ask of the option, go to buy, and then go right to covered stock? There it is, same thing. All we did is right-click on that, go to buy, covered stock, okay? Now, you want to verify, so down here below, 100 shares of stock, selling the call, confirm, it's the Mays, okay, 52.5, and the debit is less than the current stock price because it's including the premium. Now, the bad part about this is the stock could go down. And this is what we said on Monday. When you take a look at this diagram, here's the stock price right here, okay? If the stock goes to the right, the stock's going up. If the stock goes to the left, it's going down. Now, what you're now going to notice is the delta now is at 54. But if that stock goes down, 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 the loss becomes bigger and bigger and bigger and bigger and bigger, and we could just lose and lose and lose and lose. So the investor probably says, look, I don't want that. Maybe the investor says, I'm going to set a stop. So let's start here, okay? And I'm trying to start with where you probably are, okay? 100 shares of stock, selling the call. I'm going to right-click on that line, and what we're going to do is create the opposite order. So in other words, if I'm getting out of the trade, I got into the trade by buying the shares, getting out of the trade by selling the shares, okay? Now, we're going to go back to the conditional order. Limit to the market. Day to the GTC. We're going to go right back to the charts and say, look, on this, where do we see support? Well, 48.74 would be like the better area if it were to hold that, but let's try to be a little bit more realistic. We've got earnings coming up. You got 46 and change. A little bit less than that, let's say 43.62. Okay? So let's kind of use maybe even a different level. If you said, James, I'm going to set my stop, let's say a little looser, below 45.11. Now, we kind of stick to this. If the stock is less than $50, we take the support area less 3%. So since the stock is lower than $50, or right at $50, I should say, I'm going to take 45.11 times 0.97. Now, if I do 2% or 3%, we're only talking about 50 cents. Okay, it's not a huge difference. But trying to be a little bit more, give some more room here. So 43.75, 43.75. Now, if we take a look at this, we're saying if we go down to this price or less, exit the position. What is the position? Well, the position is a covered call. When you say exit the position, what is that really doing? It's buying the call back, getting rid of the call, and then selling the shares. So what matters more here, the call or the shares? That's a question. What matters more here? Oh, the call gives me income. It gives me premium. The problem is it's a capped premium. Finite, okay? The problem is the risk is with the shares. That's the risk, as we saw in the diagram. So in this case, what I'm going to go ahead and do is I'm going to come back to this. Something is actually, let me just go back to this for just a sec. Yeah. So what I'm going to do is let's put in that order. We clicked on that gear down there. I'm going to go symbol, NEM, method. We're going to say, look, if the price gets less or equal to 43.75, which you can see on the chart, we're going to say exit the position. Again, verify. Make sure that that number shows up down there. Okay? So we're saying the price of the security is less or equal to 43.75. If it does, get out of the covered call. Okay? So that's our example on that. Now, you might have your trade different. This is how we're going to do this example on the paid money account. Save the order, confirm send. Notice on this, we have two lines in red. Due to potentially wide markets that is caused by liquidity, this order may be manually substituted with limit order upon activation and worked until filled to try to get a fair fill. With stop orders or conditional orders, with stop orders, there's no guarantee the execution price will be equal to or near the activation price. So that's a huge deal. That's one of the risks of stops. Send the order. So now that trade is sitting right there. That trade does fill. Okay. Now, how can we see that? We can see the 100 shares of stock there, and you're going to see that the cover call is actually right there. Now, sometimes in a market where the VIX is higher, the spreads can be a little wider. That's normal. Okay. Is it super wide? No, it's about 9 cents or so. Okay. Now, are there any questions? Now, Thea says, how was the trade example found? Simple. So remember, when you're looking at the indexes, or if you looked at maybe products that are tracking a price, so let me throw it like this. If crude oil was crashing to the downside, do you think you could find bearish positions as crude oil is dropping down? Sure, think so. Well, the reason why we brought up the gold chart is if gold, the price of gold is going up, could some gold stocks be maybe correlated to what the gold prices are doing? So that wasn't just a waste of time. We're looking at those indexes, S&P, Dow, so on, and also products that are tracking the price. And we're kind of saying, hey, if those prices are going that direction, what might be some stocks that might mimic those prices? Now, if you had no earthly idea, James, I can at least look at the basket, okay, of indexes, or I'm going to say the F word, okay, tomorrow. But the biggest actually thing is, if you looked at, let's say, crude oil or gold or silver or whatever, that's what I mean by products that are tracking the price. If you said, I have not an earthly idea of any, okay, gold or silver, it doesn't matter. You could go to, let's say, scan for just a sec. And if you just went into this and say scan in and you said, James, all I know is gold is not a financial, okay? And if I went into this and said, I think it's not discretionary, it's not healthcare, and I'm just going to take a shot in the wind that it might be in mining, okay? And what you're now going to see is select all metals of mining. Now, from this, if all we did on this is just say, now, if I just did that by itself and I didn't put in anything, I don't know what to put in. Now, all of a sudden, I get 67 stocks or 742 stocks that really come back. Now, if I only put in the stock, like the price of the stock, and you said, James, I want $30 or higher. If we only put in that criteria, you're down to 34 stocks, okay? And so that's what's kind of crazy is how little is that? How much do you actually have to know? Not a whole lot to get a list. So that's why we kind of talk from top down. We're looking at the indexes first, okay? Then we're talking about products that are tracking prices of something, like silver, gold, so on. And then from there, sectors. Those are kind of telling us, or at least kind of leading us to say, you might want to check these areas to see if they're going up. Now, when we talked about also with that, something that's tracking prices like let's say the what we saw with the US dollar going down, well, here's the deal. This is like a teeter-totter, right? If the US dollar is going down, who's on the opposite side of the teeter-totter? There's only so many currencies that are really liquid, okay? And you're talking about a barrel that's a lot narrower than the number of stocks. Euro, pound, Swiss franc, Canadian dollar, Kiwi dollar, Australian dollar. I mean, there's only so many of them, okay, that are liquid. So I think sometimes we make it extremely complex, but it kind of becomes more like as you kind of look into it, it narrows down, hence top down. Start with kind of the index and the products, track the price, the sectors, and then the stock. It narrows down. All right, now, just real quick. Yeah, so what I want to do is I want to go back to an example. And I'm going to bring this up. So on AEM, no, let's actually just real quick. Let's go to this Mo for just a second, okay? So on Tuesday, we showed an example of Mo, and we said, look, there's shares of the stock, okay? Now, the question from JP, Josh Payne, is with current market liquidity and movement, what are your thoughts on stops versus married puts and callers? So let me hit the married put comment for just a second, okay? Let's talk about the stop and the married put. So if we went back to this, now don't worry, I've had some questions on this, so it's gonna fit in beautifully, okay? So we have the paid money account has an example on, and let me just kind of get that line chart off. There it is, okay? So we have a position in the paper money on Mo. And we kind of talked about how maybe some investors might be concerned of, could the price drop? Now, someone who's setting a stop might say, hey, James, I'm going to set a stop maybe below 55. Set a stop below 54. Set a stop below 53. Set a stop below 52, and so on. Okay, so setting a stop is a trigger to sell. Now, if we go back to the trade tab, if you said, I'm a stock investor and I set stops, well, when the market becomes more volatile, there is a greater chance that your stop could be hit, okay, and potentially triggered to sell. Now, what I'm going to do is I'm going to kind of show you something that kind of blew my mind a little bit, okay? So let's say the investor has shares at $56, and they said, James, I have a stop And we're going to kind of take one of these column headings and just go probability of touching. Okay. So when we say probability of touching, we're really saying what's the likelihood that the stock at 56 until 36 days from now could go down to the strike price. So if we said what's the likelihood the stock could go down to 55? As of right now, they're saying based upon volatility and what's expected and the time to expiration, there's an 85% chance that you could literally go down to that price. And if you set your stop at 55, you have about an 85% likelihood, probability as of right now, to have that stop potentially trigger. Seems really high. If you had 10 positions that were just like this at the end of 36 days, you might not have any positions. You might have one position or two positions if those probabilities actually do become true. Now, even if you said, no, don't worry about me, James, I set my stop at 52.5, I'm giving it a little bit more room. I'm not really sure if we're sitting on anything concrete here, because if you take a look at this, you have a 58% likelihood of having the stop trigger, okay? So if you had 10 positions and they were all just like this, at the end of the month, I'm only expecting to have 4 positions left. So that's why when the market goes down, people will say comments like, geez, I had 10 positions or so, and I hardly have anything left. No kidding. That's what this is showing you, okay? Now, if you said, well, James, don't worry about me. I set my stop down at 50. And that doesn't mean you're out of the woods either. Don't think you're sitting on a rock, okay? And you have a 40% chance if you set all your positions, all your stops, let's say the stop at 50, you have almost a 40% chance to trigger that, okay? Now, are these numbers set in stone? No. The market becomes more volatile. The probabilities of touching rise. The other thing that can cause the probability of touching to decrease or go up, etc., is going to be how many days there are to expiration, how much time there is to go down to those price levels. I'm going to tell you right now, there's some people that hate stops. They don't even use stops because of this reason, okay? Now, you can decide what you want. I'm going to show you the pros and cons. Now, the difference is when you set a stop, it could trigger to sell. We hit that. When we talk about buying a put, just because the stock goes down to where that put is doesn't mean the trade's over, because the investor has a right to sell. That's a major difference. We've seen 100,000 times, literally, probably, the stock actually goes down, and sometimes they'll come right back up. If the investor had the stop, they trigger the stop loss is triggered, and they lock in if they had a loss. Where if the investor said, no, James, I don't have a stop, but I have a long put strike, the stock fell down and went down below the long put strike, and the long put strike is the right to sell, and if that stock actually bounces back up, they still have the right to sell. They can exercise that right, but if that stock actually goes down, that doesn't necessarily mean they're out of the position. They haven't locked in anything, okay? They just have a right to sell at the strike. That's a major difference. So sometimes you're just trying to get through the volatility, okay, and trying to see if the stock can't, that if it can bounce back up. What's the con on the put? You pay for it. What's the con on the put? Negative time decay. What's the pro on the put? Define risk. What's the pro on the put? It's vega positive, meaning if volatility were to rise, it could become more valuable. Now, I want to do this just real quick. So we talked about on Mo, let's say the investor said, James, I'm a little nervous. Maybe this market goes down again, and it drags the Mo position down. So let's go back and let's do this even faster. Remember we said on Tuesday, let's say the investor said, James, I want to sell the strike above where we are now. Okay, 57.5. Current stock is at 56, and the strike is at 57. We're going to right click on that 57.5, sell, and we're going to go right to where it says call it. Now, what you need to understand here is in the last week, when we saw the volatility actually go up, I know you might have been thinking, maybe I could buy a put. But then when you saw what the put was priced at, you said, nah, perhaps. And you said, I don't want to pay that because I'm already giving back some of my money on the stock and or losing on the stock. I don't want to add salt to the wound. Now, if you thought that, you ain't the only one. Okay, so this is why now on this strategy, you need 100 shares. Most of us here are probably 40 or over, perhaps, and some of you might be flush with cash. Okay, and you say, James, I typically buy more than 100 shares. Okay, so 100 shares of a $56 stock. I don't think we would say someone's a multi-millionaire, but it's $5,600 worth of stock. We're going to go sell, and we're going to go to call or synthetic. Now, we're going to go sell that call. There it is. Let's confirm that. Buying the what? The put. Well, the put tends to be below. The strike of the put tends to be below the current stock price. Okay? Now, what does the put give you the right to do? It gives you a right to sell. Now, on this order, what we did on Tuesday is we talked about, wonder if we said, look, we want to enter the protection if the stock were going to go down. How do you do it? Well, we're going to go back to the limit order, market, day to a GTC. So remember how we kind of said that some people have a stop loss set up? Well, some people that said, I don't like those probabilities, they have a trigger to enter the option protection. Okay? And now what we're going to do is going to click on that gear. And now what I'm going to do is say, look, symbol, let's say if Mo gets at or below $54. Okay? So you might say, look, if it gets below $54, I think in the shorter term, the trend is softening. Now, the million-dollar question is, why don't you just sell everything in your portfolio? Well, you might have some large capital gains on those positions. You might have those gains for those stocks for 2, 3, 5, 10, 20 years. And maybe those are some stocks that are also maybe paying some dividends and so on. Okay? Now, the risk with this is, speaking of that, why I brought this up, is if you sell a call, someone has a right to buy those shares at 57.5. That's a risk, okay? Your shares could be taken away and given to someone else at 57.5, but they have to give you 57.5. Wanted to bring that up. That's a negative of that trade. You can think of it as a negative, okay? Now, you might say, well, it could be a positive, too, because that means I was maybe making money, okay? I don't know where everyone else is, okay? I just want to kind of lay out that scenario. We're going to save the order. Now, let's kind of confirm this, okay? So if this stock, we're selling the call that's above the current stock price, buying the put below the current stock price, and we're saying enter that position if we were to go to that price or less. Now, if we sell that and we say send that order, now there's a pending order for protection. I think that's something important that a lot of investors, when we talk about the most important lesson is learn to manage risk. Position sizing is a way to try to manage risk. Setting a stop is a way to learn to manage risk. Buying a put on shares of stock you own is a way to try to manage risk. Hollering is a way to manage risk as well. Okay? So I want to kind of just show that as well. All right, now the comment from Josh is, now I need to figure out which put strikes on the delta to use. So let's kind of just bring this up if you don't mind, okay? So when we talk about this, okay, and I'm just going to hit this quick, but when we actually bring this up, if we had, example given, 100 shares of stock, okay? Okay, we need that because we're selling the call. And so when we sell that call, the starting point, we're going to look to sell the call or consider, okay, the call that's out of the money or above. If we said out of the money, we're probably talking about something that has a 30 to 40 delta, okay? Now, do you have to sell that one? No, you can change it. But if we're talking about selling above the current stock price, it's probably very, very likely that the delta, the 1 or 2 strikes out of the money is the 30 or 40 delta. Now, we're going to try to take this, is going to be credit. Now, on the put side, we're going to go long the put, okay? And with that long put, if we said out of the money, that on the put side, that means below. So if we actually said this same thing, consider. And if we said, well, what delta does the long put have? Well, the delta, the long put, if we say out of the money, it tends to be a delta of 30 or 40 on the call and the put side. So what you're now going to notice is if we said, hey, I sold the call and it had a delta of 35, I bought a put that actually had a delta of 35, and I had 100 shares of stock. That means when the investor does the position, 100 shares of stock, 100 delta. Sell the call, negative 35. Buy the put, 35, negative. And you said, look, on my position, the delta is 30. Okay? So now if the stock goes up $1, the position net is going to be up about $30, approximately. If the stock goes down $1, it's going to be down about $30. One of the major differences on the collar compared to other strategies is the delta stays pretty similar because these offset each other. That's a major difference, okay? With cover calls and long puts or married puts, you can have substantial changes on delta. With a collar strategy, these two are offsetting each other, and the delta on the position stays pretty close to 30, which that's interesting, okay? Now, let's actually go to this just trade real quick. Now, I want to bring up just one stock. We got JP Morgan actually announcing earnings tomorrow. Now, there are some investors who are thinking, James, I'm a little concerned on some of these positions and how they might fare given on the backdrop of what's happened. And let's say the investor says, James, we got earnings tomorrow, and I want to start practicing positions that are bearish, like we talked about on Monday, okay? So we talked about stock position. We did that. I showed a cover call example. We did that. I talked also about a collar. We did that. But what if someone said, no, James, I don't want the share. I actually think the price is going to go down. Well, remember we talked about 3 option strategies. The short call vertical, probability based, income based. We talked about the long put vertical, directionally based, typically less probability, higher potential profitability, typically if we set them up the way we talk about. And then also, last one is if we actually bring up a short synthetic. Now, one thing I want us to kind of note here in doing this trade is we're going to sell the call, okay, at a delta of 30 to 40, out of the money. And if we do that, what you're now going to see is we're going to sell the 240. Wherever you sell the call, okay, that's where you think the stock might not be able to get above or close above, okay? Now, on a short call vertical, do you or do you not have the shares? On a short call vertical, you do not have the shares. If you did a short call vertical and you don't own the shares, this is a bearish position. When we come to this and go confirm and send, now we can actually see what the break even is, 241.80. Max profit is just the credit, and the max loss right there is really 320. That is coming from a $5 spread width less the credit. And that's where that's coming from, okay? Now, what you're now going to notice is if we said, hey, what's the cost of the trade? 65 cents times 2, each leg of the option being $1.30. We're going to go ahead and send that. Now, in the last 2 minutes I have, I want to kind of point out some stocks that might be a little bit under pressure, okay? Now, we know when there kind of might be more recessionary discussions, there might be some products or industry groups that might be at risk of decline. Now, so if some people say, look, I'm only going to buy stuff that I really need, okay? Now, if you ask my neighbor, he's a good guy, okay? I'm not saying this bad. He could be listening right now. I love my neighbor, okay? I just want to say that on public. Now, stocks like, for example, HOG, Harley-Davidson, they might be under pressure. They've been in a bearish trend, okay? That's one that we're going to kind of keep an eye on. Might that trend continue to the downside? And also, might the company warn of kind of some of the things news-wise that we've been seeing, and also maybe some of the demand for their product. Now, in the last minute that I'm going to pull up here, the one we're going to target is Polaris. Why? Well, Polaris kind of in that same backdrop, but the one thing that's kind of the situation that we're seeing right now, and I want to see if you can notice it here, Polaris actually has an 8% dividend yield, okay? pays a quarterly dividend of 67 cents, and that's on a quarterly basis. So if we looked and said, well, what's that dividend been over the last year? It's been about 268. If they pay 67 cents times 4, it gets you to 268. Now, the interesting thing about Polaris, which is a little concerning in the last 30 seconds, is when you take a look at, let's say, the fundamentals, and we said, what's the earnings per share for Polaris? 195. So companies like Polaris, their dividends might be more than the earnings per share. This is where the company might cut a dividend. They might do a lot of things. I mean, usually when you start talking about cutting dividends, the company is thinking fundamentally they're starting to deteriorate and they want to not pay a dividend potentially and try to make sure they actually build cash in case that actually downtrend were to continue. I'm out of my time here today, but keep an eye on more and more companies that might be in that situation. Polaris, kind of in a Citigroup of 2007 scenario, where now the dividend is more than the earnings per share. Okay, keep an eye, look for other examples on that. Now remember, with what we talked about here today was done for example, illustrative purposes only. We showed stock examples. We talked about covered calls. Talked about through Josh Pink, through the example of protected puts and callers, and also even did a bearish position as well. Practice these bearish strategies and get more comfortable with them as homework. Stay tuned for our next class coming up. Thanks, Brent, and thanks to all of you. And this has been the class on Trading the Trend. Take care. Bye-bye.